Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us the bear rally has run out of steam. He comments on the US dollar, crude, and copper. Author of The Money Bubble, John Rubino, believes we're heading for a recession and gives us the factors that has him thinking that way. He outlines strategies to protect yourself. Wolf Street's Wolf Richter tells us despite high interest rates, consumers in the U.S. are still spending. He says while the Fed might be able to crash buying, it can't control services, which are much more expensive now. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure, Jim.
Ross, so we did have what people were calling a bear rally. How did that work out this week?
Well, the bear rally ran out of steam. You know, it was, I think, the better part of about 2.5 weeks ago. We got a lot of big overbought readings, the kind of things where when we get a cluster together of high relative strength readings, the RSI or the R exhaustion index gets up to an extreme. We put together a list and sent it out, and gosh, some of the names that were in there, it was the Poltais and the Teslas, you had Meta, some of these big names had just run too far too fast, and it was clearly the market was ready for a period of consolidation, and the optimum was going to be that you'd correct back to their 20 or 50-day moving averages, and then see how you react from there. And at this point, pretty much most of all of those stocks got back below their 20-day averages and had a minor bounce. But if you take a look at the indices this week as a whole, the areas that they held at were reasonable. A week ago, the midweek bounce this week after the first break was just really had nothing behind it. And at the end of the week, the granddaddy of all, in terms of influence on the markets, is that U.S. dollar index. And it just decided that this was the week it was going to put on one substantial move. So anything priced in the U.S. dollars, with the exception of the energies, anything else just took it on the nose.
How did crude do?
Crude ended up, now we're still not breaking out. We're not having anything substantial on crude. We're sitting around 76.5. Did a test of support area down around 74-ish, but it's continuing to get itself boxed in more and more. I mean, this is, if you take a look back, crude, really the momentum low was into the end of November, and we've been plus or minus maybe $3 or $4 ever since then. So just a consolidation within the downtrend that started back in the summer when we were up over $120 a barrel. Now, if the work that I've done, if this market can't get above $80, then the likelihood is we take out the support, and the major support from me on oil is somewhere down around 61 or 62. So we'll take a look at this another week from now and just see whether it's managed to hold itself. Other items in the complex starting to show some decent buoyancy. The gasoline market, which we're right now about a couple of weeks into the seasonal upside move. We anticipated that it would be a choppy one this year. It got off to a first start at the late part of January, early February. Got knocked back, gave it back about half of its gains, and now it's showing better relative strength that we've seen in the oil market. Maybe this thing's on its way, and if there was a seasonal trade to be looking at, I think nat gas gasoline would be on that list. I had a little slip there saying nat gas, and I think that's because it's probably been the most hard hit of anything in that complex. We've gone from $10 all the way down to $2 this week, and staged a really nice reversal. So we're so oversold that by the time we see this reversal, we've been from say down to 2 at the early part of the week, and now we're back at 250. The degree that we've seen on this oversold reaction the last 3 or 4 months is such that a rally back maybe into the mid 3s is a very viable bit of analysis that we've got, and that doesn't seem like a big move when you've been at 10. Percentage-wise, if we're making a move from 2 to 3.5, there's some decent money to be made there.
What's going on with gold?
U.S. dollar. That's what's going on with the gold market. The gold was holding in nicely at a 38% retracement, coming off the top where we peaked around 119, 160. This is a 38% retracement a week ago from the lows that we put in October, November, and it was a nice oversold level. But the rally lasted only a couple of days, and then by the end of the week, we've taken out that support level. We've gone from an oversold condition to having this dead cat bounce, and we probably have to see something under 1,800 before more towards a 50% correction from October before it's got any chance of putting in a base. And I think we mentioned last week that basing activities, you got to be a little patient here and let it do that. The silver market, the same type of action there in terms of an inability to really get anything going. It had been down instead of 38%, it had given back 50% from the summer lows, and gosh, it was just I think about a 2 or 3 day rally. That was it. And until we get either some good capitulation signals or a basing activity, I think you just want to stay away from the silver market for a little while here.
What's happening with imaginary money? I mean, cryptocurrency.
Cryptos, this has been a pretty good year for them. But if they closed off the week around at 23,100, has managed to establish a decent base if we look at it all the way from the summer. That 25,000 was the peak in July. We dropped off to 16,000 and then made the turn. We've had 2 series of overbought readings and decent corrections since the beginning of the year. We're in the midst of this second correction right now. If that, in terms of the price action, if it really, I would say it needs to hold at this 22,000 level to keep the uptrend in motion. And if it can clear through 25,000, then you could really get some life in it. The longer term moving averages, like the 50-week, have been a cap here in this last week and a half. And if we look back historically, getting through that would be pretty darn important.
And of course, we were talking about Bitcoin there. Anything happening in Dr. Copper's clinic?
Dr. Copper was in just a really good run into the middle of February, or middle of January, I guess it was. We got up around the 4.25 to maybe as high as a spike high into the 430s, but rolled over this week with that strength in the U.S. dollar. The inclination was that what's good for copper is good for the market. Well, at this point, with the stock market rolling over and having difficulty, I guess it's not a bit of a surprise that copper has ended up the week at its worst level that we've had in about a month and a half. And this, if we take a look at away from the daily charts into the weeklies, it's really going to be important here that it holds in the probably in that 375 to 380 range.
Anything happening with lumber?
Lumber, it ended up with a bit of a bounce at the end of the week here, and but this was a $1,400 price, 6 months, 8 months ago, down under 400, a decent bounce, and now back under 400 with a smaller bounce. Going to take lumber a long time, I think, to find a decent level in here. And if anything, those kind of numbers that we saw last spring and a year ago, those are going to stay as ones for the record books that we don't see for a long, long time. And with interest rates the way that they've been, even if they come off a little bit here, the demand in terms of housing, clearly it's we've lost a big chunk of the potential buyers out there, and it's going to take a while for them to save up enough to go ahead and either build homes or do the renovations and upgrade what they've got.
Ross, thank you so much for chatting with us.
Always good to be with Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.substack.com. Welcome back to This Week in Money.
Hey, Jim.
John, do you expect a recession this year?
Absolutely. There are so many things pointing towards a slowdown right now that it would be shocked if we didn't get one. I'll give you some of the, some but not all of the indicators. We've got a inverted yield curve that is as inverted as it's ever been, and without going into too many details about it, that usually presages some kind of a big slowdown. We've got a shrinking money supply in the United States, which almost never happens. The M2 money supply is now shrinking. And when you're running a Ponzi scheme, you cannot let the inflow of new cash shrink or it blows up the whole system. But we've got it now. The housing market is totally rolling over. House prices got way out of control back when mortgages were only 2.5% per year for 30-year fixed-rate mortgages. Now we're close to 7%, which means the monthly cost of the same house is almost twice as high to finance it. So hardly anybody's buying houses. The housing market is imploding, and that's a very big financial and psychological sector. And the last thing, which is probably the most important thing, is that U.S. credit card debt is soaring. It's at, I think, record levels now. It's over $1 trillion. which means that people are putting day-to-day expenses on plastic and then paying credit card rates like 22 or 23% in order to carry those balances forward. That's a recipe for personal bankruptcy. And in this case, it's personal bankruptcy at scale. 1 million people are going to have this happen to them in the year ahead unless something changes, and nothing is changing. So anyhow, add it all up, big slowdown coming, big recession probably, and very probably equities bear market. So lots of bad times this year.
Mm-hmm. So what would a recession mean for stock prices?
Well, that a slowdown in the economy normally causes corporate profits to fall. And that in turn causes stock prices to go down because stocks are basically just a claim on future corporate earnings. And if the company that you're investing in sees its earnings fall, then your share of the future earnings is lower and the stock price is worth less. So that's a big possibility going forward. And, the other thing with stocks is that interest rates have gone up so much in the U.S. that a short-term, super safe money instrument like a bank CD or a money market fund now pays you more than the dividend on most blue chip stocks. So why take the risk of holding something that can drop by 30 or 40% in a bear market when you get a guaranteed return that is higher than the dividend on the stock you might be speculating in? So that's another reason. When interest rates go up, stocks go down. So we're probably on the verge of something like a 2008, 2009 bear market in equities. We've already seen part of it. The last year was a down year for stocks. This year could complete the 40% drop with another 20% drop very easily.
A friend of the show, Martin Straith, last week says he advises his clients to avoid long-term government debt instruments, treasury bills that are, say, 5 or 10 years out, because he fears governments won't have the money to not just pay the interest on that, but just give you back your principal. Do you think he's wise to advise that?
Oh, governments have the money to pay us back. They just can't control the value of the dollars that they're going to pay us. They're actively making the currency less valuable, which means they're totally able to create enough currency to pay back a 30-year bond, the principal on a 30-year bond, but the dollars they use might be worth 1/8 as much by the time you get 30 years out. Meantime, you can get a 6-month bank CD that pays you as much as a 30-year treasury bond, at least in the U.S. right now. So why bother with long-term interest rate risk when you can lock in a higher return in the short run and then probably roll it over for an even higher rate 6 months from now? So I think virtually no one in their right mind would be buying treasury or 30-year treasuries right now, just because if there's a recession, which is generally good for bonds, that's normally why you buy a 30-year treasury bond. Either you're very comfortable with the world as it is, or you expect a big slowdown, in which case interest rates are liable to fall, which would make the price of the bond go up. But this time around, central banks will have to so aggressively ease in order to get us out of the next recession that it will probably raise inflation to the point where long-term interest rates will go up and long-term bonds will go down. So that's not a risk-free asset. It's not even a safe asset anymore, long-term government bonds. So stay away from them, because the short-term paper pays you more at zero risk, or almost zero risk, and that's where you want to be right now. Risk-free return is better than return-free risk, as people like to say.
How will central banks respond to negative growth?
Well, they're going to go to negative interest rates almost certainly in the next couple of years. And I know that sounds crazy now, because all of a sudden we're back up to 4 or 5% interest rates. But they're going to panic on such a vast scale when they see what happens to the global financial system with interest rates even this high right now. We're looking at the U.S. government rolling over its super cheap paper that it's used to borrow into higher and higher rates, so that we're going to be paying $1 trillion a year just in interest costs starting next year, and it's going to go up from there. Japan is in even worse shape. The central banks of the world are going to see that, and they're going to see that it gets even worse in a recession, and they're going to try to do everything they can to fix it by lowering interest rates and stimulating the economy. And this time around, well, we know what happens now. 2022 was 10% inflation in the U.S. With even more debt in the system, let central banks try to go back to easing on that scale. Put us back into negative interest rates, for instance, and we'll get a resurgence of inflation. We know that now. And the central banks of the world know that too, but they can't let mass bankruptcies happen. So they're going to have to choose between those two scenarios, and they're going to choose the inflationary scenario because, first of all, that's all they know. They only know easy money. That's the only tool in their toolbox prior to this recent panic tightening, but they don't want to stick with that. They want to go back to easing, and they will do it as soon as they can. But this time around, it's going to be destabilizing for the world's currencies. So my prediction is that we're pretty close to the end of the whole fiat currency thing. It's a failed experiment, and people are going to figure that out when they realize that central banks cannot fix the problems that they've caused.
Are any of the problems that underlie the current mess being fixed?
None at all. Basically, the underlying problems that we're now dealing with stem back to really 1971, where we went off the last vestiges of the gold standard and gave the world's governments unlimited credit cards via monetary printing presses. And they've been causing credit to be created at an accelerating rate ever since, so that we are so deeply in debt right now that it's impossible to, they're not fixing it. You'd have to cut government spending dramatically and scale back economic growth. In other words, you'd have to tighten to the point that you have a 1930-style depression to get us out from under all this debt. They won't do that. Meanwhile, even if they stop tightening and just leave interest rates where they are, which I think is the plan for mid-year 2023, they're going to raise rates one more time maybe in the U.S. and then stop for a while. But even if they just keep interest rates where they are, stop raising them, rates go up. The average interest rate goes up for most of the borrowers in the world going forward, because everybody who's got debt out there that has to be rolled over will be rolled. It'll be rolled over at a higher rate, which raises the average interest rate for the entity that's doing the debt rolling over. So whether it's the Japanese government, or whether it's IBM, or whether it's the U.S. government, or whether it's a small business person with a variable rate loan that rolls over sometime in the next couple of years, they're all going to see higher interest costs at a time when they're already financially strapped. And that's the underlying problem now. We've got this kind of death spiral going where interest rates rise. That causes interest costs to rise, which has to be borrowed to be covered, which raises the total amount of debt, which raises interest costs, and so on, in a never-ending cycle where things get harder and harder with no end in sight, and until whatever it is blows up. Whether it's the Japanese government not being able to borrow anymore because the markets decide they're insolvent, or big companies that borrowed tens of billions of dollars in order to buy back their stock, and then their stock falls. So they take a kind of a paper loss there, and their interest on their debt goes way up, which lowers their profitability, which lowers their stock price even more. You got all these feedback loops out there that begin with higher interest rates and continue on to insolvency. And none of that is being fixed right now. We're still borrowing as much money as we ever were. We're taking on massive amounts of new debt, even in the face of the previous massive increase in debt, which led to 10% inflation for most major countries. So there are no plans on the table to fix anything. The only thing they're trying to do now is get themselves through the next election cycle, or the next corporate reporting cycle, or whatever. They just want to survive to get past the next time when they're judged by whoever it is that's giving them their job. And they might do that, but they will not fix any of our long-term problems.
Could they declare, I guess, like after the Second World War, when the whole world economy had been turned on its ear, kind of a debt amnesty, at least for governments, and start from zero? Do you see the world doing that or attempting that? And if they did, would it solve the problem?
No, it wouldn't solve the problem, because then they would just be financing themselves with newly created currency, right? We'd be in monetary or modern monetary theory territory then, because basically there is a theory that says governments don't have to borrow. They can just print as much new currency as they need. Anybody with any sense understands that means that's a green light for governments to basically spend insane amounts of money, destroy the value of the currency, and send the financial system off a cliff. So just declaring government bonds null and void would do two things. First, it would spook the markets, as I outlined. And second, all the people who own those bonds would then take a gigantic hit. So you would be impoverishing everyone who trusted you, if you're the U.S. government, for instance, by stiffing them. And if you wipe the debt out by just creating a lot of new currency and paying off all the old debt, then the value of the dollar would collapse, because you will have increased the money supply by 200%, let's say. And, we increased the money supply in the U.S. by about 40% in 2020, 21, and 22. And we got 10% inflation in 2022. So to create enough currency to wipe out the government debt would be some multiple of that, both in terms of the increase in the money supply and in terms of the inflationary impacts. So no, there's no fix. There's no easy fix where you just say, oops, never mind about the money I borrowed. I'm just not going to pay it off. And no, look at me. I'm financially healthy because I don't owe anybody anything. You can't do that.
Is the petrodollar about to be replaced by the petro-yuan?
Not be replaced, no, but the petrodollar, that is the dollar that, by agreement between the U.S. and Saudi Arabia, is the only currency that you can use to buy oil. That's kind of going away, because other countries are starting to do deals where they trade oil for gold or for local currencies, because nobody wants to be dependent on the U.S. anymore. We turned out to be really bad neighbors. And we weaponized the dollar as the world reserve currency, and the fact that we control the international bank settlement system. And we used it against anybody who stepped out of line with the official policy of the U.S. empire. And nobody likes us anymore. So lots of different countries are looking for different ways to get around the U.S. dollar. And you're seeing the BRICS countries, which is Brazil, India, BRI. Oh,
Russia.
Okay, anyhow. Yeah. Brazil, Russia, India, and China. Yeah. But those countries are banding together to create a currency union that will compete with the dollar. And interestingly, other countries are applying to join, including Saudi Arabia. So, if the petrodollar depends on Saudi Arabia's willingness to take only dollars, and they're joining a competing currency union, then that's a very big deal. It doesn't mean the dollar goes away as an instrument of international trade, because we still have a lot of advantages. We've got, a massive base of government bonds trading out there. We've got huge amounts of debt otherwise in the world that's denominated in dollars that requires dollars to be paid back. And we've got very deep and very liquid capital markets. So that means the dollar still works for a long time as an instrument of trade. But as a store of value, I think it's a lot less bright, the future of the dollar, because right now the people who hold dollars, a lot of them hold dollars because they're going to need to buy oil. If they don't have to do that, they don't need those dollars. Or they're holding dollars as reserve assets at their central bank. Well, if they can hold other currencies or gold, then they don't need all the dollars that they now hold. And they're going to take a lot of those dollars and send them back here and say, I want to buy U.S.-based assets with my dollars. And that's going to be very inflationary. So say 20% of the dollars sloshing around in the world out there come back here. That'll lead to a big decrease in the value of the dollar. So yeah, the petrodollar is not what it once was. The dollar in general is not as rock solid and stable as it once was in terms of international trade. So I think the next few years, we'll see kind of a reevaluation of the dollar as the only means of exchange in the world. I think it'll be joined by other currencies, and we'll have a multi-currency world now, multipolar world and a multi-currency world.
The push for digital currency, is that going to make it easier for governments to freeze or seize your bank account, or is our money in the bank already just nothing but zeros and ones that can be easily stopped?
Well, probably yes to both of those. A bank account can be looted by the government. We found that out actually in Canada. A lot of bank accounts were frozen, right, during the
Freedom Convoy. Yes.
Yeah. So we found out governments are willing to do stuff like that, and if Canada will do it, the U.S. will do it. So our existing financial system can already be invaded and confiscated by governments. But a central bank digital currency would be that kind of risk on steroids, because it wouldn't just be dollars that are out there. It would be programmable currency in an account at the Federal Reserve. So if you're just stocking up digital dollars in there and you're not spending them, the Fed could decide they want you to spend to stimulate the economy, and they could just declare that your dollars, your personal digital dollars, are going to lose value at the rate of 10% a week until you spend them. Or if they don't like what you're spending your money on, they can just ban you from buying certain things. Or if they don't believe you're a good enough citizen, in other words, if you are not backing government policies, if you're proposing policies that contradict what the government is trying to do, they can just clean your account out. They can just empty it. And what do? Can you go to the police when basically the government is the police? No. So they own us when they institute a central bank digital currency. And if we let that happen, then we're going to get what we deserve. We will be the slaves of a techno dictatorship, the likes of which the world has never seen before.
Where do gold and silver fit into the chaos?
Well, those are the old monies that governments can't make more of and that have held their value for the last 3,000 years. So I think they're the base of a smart person's financial life. You should, first and foremost, get yourself a bunch of gold and silver. There are lots of different ways to store it. That's a separate conversation, but store it in ways that you consider safe and accessible. And know that they will hold their value during all the chaos. And then once you've got that set up, then you go beyond that. If you want to invest, if you want to have a brokerage account, you can buy gold and silver mining stocks. You can buy other kinds of real asset mining stocks. Energy stocks are good behavior or good choices right now. They've done very well lately, and they'll probably continue to do well. Copper is very interesting. Uranium is very interesting. There are a lot of things you can buy that will probably benefit from the financial insanity that we'll see when central banks start cutting interest rates again. There's a debate going on about whether it makes sense to have a brokerage account, or whether that can, if the internet just shuts down, how do you get to your stocks if they're in Charles Schwab or someplace? So that's another thing that could take up a whole show of ours here, but that has to be thought through. I personally have a fair bit of my money in brokerage accounts, but I'm aware of the risks of having money online and what could happen if there's an EMP attack, or if there's a cyber attack, or if the government decides to nationalize the financial system, and on and on. Lots of things could happen. I'm kind of talking myself out of this whole brokerage account thing as I say this. But that's a means for you to invest in things that will do well. And then certain kinds of real estate, move money into farmland. If you can buy food-producing land, then you've got something that governments can't create more of, and that the aristocracy is aggressively buying. So Bill Gates is the biggest buyer of farmland on Earth right now. In terms of private individuals, and that means that he expects farmland to rise in value because we're going to have giant food shortages pretty soon. So farmland is an excellent thing to buy. So if you've got lots of gold and silver, some food-producing land, maybe a rental house for cash flow, and some oil and some gold mining and some uranium stocks, you probably come through this in pretty good shape. Good shape is it's a relative term, and it's also an open-ended term because, for instance, during the Great Depression, a lot of people just flat out made fortunes. They guessed or bet correctly based on what they saw coming, and they turned out to be right, and they made insane amounts of money. The same thing is going to happen this time around for the people who position themselves correctly for the chaos and the outcome of the chaos. And I do think real assets are the general category in which you should be playing right now if you're going to try to do that, with one other kicker, and that is shorting the market. Betting against the financial market is usually a bad idea because you got the Federal Reserve on the other side of that bet. But right now, the Fed has tightened. It's letting the money supply shrink. So shorting the stock market, by that logic, would be not fighting the Fed. It would be being on the same side as the monetary authorities. So I think learning how to short stocks and short market indexes is probably the homework you should take away from this. Go learn how to do that, and then do a little bit and see how you feel about it, and then do more, because there will come a time, sometime in the next couple of years, when the guys who are short this market make serious money.
John, anything else we should be keeping a close eye on right now? I'm wondering, will this de facto war, the East-West thing that's happening in Ukraine, is this going to become a trade war where China backs Russia and then India decides who they're going to back and so on, and it turns into a massive tariff and boycott war?
You know what? A trade war would be vastly better than where we are today, because we're very close to a shooting war against a nuclear power right now. And we're talking to China as if we're considering them as part of the World War III we're designing. So it could easily turn into a shooting war between the U.S. and Russia and China. That's too terrifying to think about. Something like that makes everything you and I just talked about irrelevant, because it's vastly more important than any kind of finance thing. Monetary policy does not matter. Gold and silver don't help you if there are nuclear weapons falling on your town. So hopefully that doesn't happen. And if we get a trade war, so be it. That accelerates and intensifies the monetary chaos that is coming in any event. So the things you do to protect yourself from rising inflation and instability and chaos in the stock and bond market, stuff like that, that's basically what you should be doing to prepare for a gigantic trade war where supply chains shut down and stuff like that. If we thought the supply chain chaos over the last couple of years was scary, wait till you see what could come, if we really ramp it up. And that just means you really need that homestead. You need that food-producing property somehow. And it's possible to set up roof gardens and patio gardens and things like that. We shouldn't let the fact that not all of us live on land stand in the way of finding a way to become at least 10% food self-sufficient. Any little bit is going to help. If we have messed up supply chains, a trade war, all of that kind of stuff, and food is one of the big victims of that. I think it's completely possible. I think it's something that if we can plan for it, we should be.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.Substack.com. Coming up, Wolf Richter, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, they say that peak inflation is behind us and that inflationary pressures are abating, but what's your outlook on inflation?
Well, when you look back into history a little bit of inflation, once it starts boiling over like it did, it becomes very unpredictable, and it dishes up a lot of head fakes and surprises and nasty surprises. So it goes down and goes back up, and the problem is that some prices of some goods or services go down, but then in some other corner of the economy they begin to spike, and so you get these counter reactions, and we're starting to see that. So many energy related prices have come down very hard. Gasoline, natural gas, and electricity too, to some extent. We have seen, so that's good. So that lowered inflation. We have seen prices of durable goods come down to some extent, and that includes used vehicles. And they had spiked by a ridiculous amount in 2021 and 2022, really 2021 and early 2022. And since early 2022, they've actually been declining. And then other durable goods prices fell as well, electronics and other items. So the overall basket in the United States of durable goods is negative, has negative inflation. So the prices are actually lower than what they were a year ago. And food inflation, that has calmed down somewhat. But now the big thing that we now have is inflation in services. And that has spiked and has spiked to 4-decade highs, and by any of our inflation measures that we use, and it continues to spike. And services is 2/3 of what consumers spend their money on, so that's the biggie. And it includes housing services, and it includes all kinds of insurance and financial services, and then it includes travel and education and everything you pay, the healthcare services, the personal services, all repairs of any kind, and if you've taken your car to the repair shop, you know what's going on. There's not a little bitty inflation of 3%. If you had the same repair done a year ago, it's up a whole bunch. And all of the services I use for my little company, for example, and that's not retail really. I mean, that's not a consumer. It doesn't go on consumer price inflation because it's a company-based expenditures. But they're all 20% or higher. So this is the service spectrum we're now looking at. Inflation has taken off there. It is very, very difficult to tamp down on services inflation, and that's where the hotbed is right now. Is in services. In goods, the prices are coming down. Or, I say that they came down, but now I'm looking at the used car market and in the wholesale on the wholesale level, we're now in the third month of price increases again. So they haven't washed through the retail side yet, but they will within a couple of months. So we'll see retail prices at least stop falling, or maybe going back up on the used car side. That was a big driver in this inflationary scenario. Disinflation, this kind of new word for less hot inflation. And used vehicle prices were part of that drove it down, and now in the wholesale market, I can already see used vehicle prices coming back up. And so we'll get these head fakes. We get these nasty surprises in inflation, and I don't think it will go away. It dropped. It was 9.5% in the United States at the peak. I don't think it will go back there. I don't see that, but I don't see it going a lot below 6%, and it may go back up to 7%. And the headline inflation, the core inflation, which is what the Fed looks at, that is really not going down. It's just not moving much on, and especially when you look at the last couple of months, it heated up again. And so I don't expect inflation to go away. I expect it to linger. The central banks are not willing to crash the economies to the extent that it would be required to get this kind of inflation under control. So they're trying to engineer soft landing. They're not engineering any kind of landing, it seems, right now. The economy is just, is going along at kind of a relatively slow growth, but consumers are spending, businesses are investing. Employment is the labor market is very tight, so you don't have the classic signs of our economy going into a recession at this point, and a mild recession wouldn't even be enough to get this inflation down. This is something that would require a major and long recession, and the central banks are not willing to do that. There's no political will to do that. There's no political will to drive unemployment to double the unemployment rate. That's maybe what it would take, but I don't see that. So they're going to run in the interest rates up a little higher than where they are. So the Fed will go over 5%. And maybe go to 6%, and then inflation won't really go away at that. It just kind of doesn't get worse. And so we'll have a period of relatively high inflation with relatively high interest rates, and maybe the inflation will come down a little bit, and the Fed will lower the rates a little bit, and then it comes back up, and then the Fed will have to hike rates again. So I think this will drag out for quite a while. I think that scenario of going back to 2% inflation with what the central banks are now doing is just illusory. I don't think that's happening. I don't think it can happen. Inflation has taken off. It's in services. It's very difficult to get back down once it's in services. You can't really do that unless you crash demand for services. And you can crash demand for goods pretty easily, but for services, some of them are essential services. And you have to really hit the economy hard with very high interest rates to get that under control. And I don't see that happening. So I think the peaks may be behind us, but in headline inflation, but I don't see inflation going away the way we see it right now.
Could the bank rate and mortgage rates de-link at some point where mortgage rates could move higher and faster than the bank rate?
Well, that could be. Mortgage rates are really a sort of a market rate, and it could be that there's a divergence eventually. In Canada, your most of your mortgages are based on shorter term interest rates. In the United States, our classic mortgage is a 30-year fixed rate, and it means fixed in the United States, meaning the interest rate, nothing changes for 30 years. You don't really have that in Canada. So we have seen in the United States, a divergence between the 10-year Treasury yield, for example, that normally is a guidepost for the 30-year mortgage rate, and the 30-year mortgage rate. So the 30-year mortgage rate is now approaching 7% in the United States. The 10-year Treasury yield is below 4%. That's a big spread between the two. So we've seen that divergence. The Fed has raised its policy rate to close to 5%. The 10-year Treasury yield is below that. So we've seen a big divergence there going in the opposite direction. And so markets are doing their own thing. I think mortgage rates will likely be in Canada will likely be close to the bank rate. The way it's structured, it could be a little bit. It could go a little higher, but I don't see, because you're so focused on the short-term rates, I don't see that there's going to be a huge divergence as we are now seeing in the United States.
You live in San Francisco. What's the housing market doing in the Bay Area?
Gosh, yeah, it is an amazing thing. I've been through the last housing bust here. I don't remember ever even thinking it in those terms, In the San Francisco Bay Area, between the peak, which was last spring, and now, the house prices have plunged about well over 30% now. So in less than a year. Year over year, they're down 17%. It depends how you define a crash, but something goes down more than 20-25% in a year in housing, to me, that's kind of a crash. It goes down 30% in a 10-month time span. I will call that a crash. There's a unique confluence of elements in the Bay Area. So this is probably the worst housing market in the United States right now. We have the layoffs that you read about in the newspaper. A lot of these companies are headquartered here in the Bay Area. So, and I checked the actual layoffs, so not the ones that they announce in the newspaper, but the actual layoffs that have to be reported to the state of California. And, they're still not huge in California, but they are concentrated in the Bay Area. So, then there are people that are threatened by these layoffs. They don't know whether they're going to get laid off or not. And so the laid off employees, they're not going to buy anything. And, the people that feel threatened by these layoffs, they're not going to buy anything either. And hiring freezes are spread across the Bay Area. So they're not bringing in new employees with these high salaries, at least not to the extent that they used to. And so that influx of highly paid people isn't happening, and they're not buying anything. And so there is just a real demand issue here. You don't have that demand. And then, of course, we have this huge spike in house prices here. It was just ridiculous how they spiked, and that spike is now being worked off. And it just doesn't make sense for anybody to buy anything right now in the Bay Area. It's just, when the house is priced right, it will sell, but sellers often don't want to do that. They want to, sort of see what they can get for their home, and so they put the home on the market here, and then it doesn't sell. Then they put it on the rental market, and they can't find any renters for it, and then they pull it off that, and then a month later they put it back on the for sale market with a much lower price, and it still doesn't sell, and they pull it, and they're relisted a month later with an even lower price. So they go through this procedure trying to figure out or the clearing prices for these houses, and it's really terrible. And of course, it's not a surprise, because a spike in house prices cannot survive. It just doesn't work. And you cannot assume that this will be just a plateau from that spike, or that it will keep on spiking. A spike like that has to unwind. That's just economic reality in any market. And now in the Bay Area, we have the challenges of all the tech layoffs and social media layoffs, and the uncertainty that breeds. And so the demand has just essentially vanished. So if you want to sell a house here in the Bay Area, you have to price it right, which means you have to price it a lot lower. And those deals are clearing. They're selling homes when they're priced low enough. And but that's a tough thing to do. And most people who bought their homes in 2019 or before, they're still above water. They can sell more than what they bought it for. And if you bought a house, 20 years ago, or 10 years ago, you're not going to have any kind of problem. But the people that bought in the last couple of years, they're massively underwater now. And, and the others are seeing the imagined profits vanish. They thought they'd made $1 million on the house, and now that $1 million is mostly gone. And, that changes attitudes about everything. So this whole attitude that you can get rich in housing in the Bay Area is now reversing, and people are losing the equity. They're more than their equity in a very short amount of time. And I don't know of another housing market, a large housing market. There's 8.5 million people in the Bay Area. I don't know of another large housing market like this in the United States that's as badly off as we are here.
Do you think we're in for a housing crash in Canada and the U.S.?
Well, nationwide, that's a difficult question. It rarely happens that all housing markets across a country, across big countries, big diverse countries, kind of come down together. Usually, you have parts of it that go down hard, and other parts that kind of hang in there, and some parts may still go up, and so the nationwide numbers are kind of averaged out over that, and so they don't really move that strongly. A crash, in my definition, is something that goes down in housing. It's something that goes down 25% or maybe more, and I would call that a crash. Something goes down 30%, and last time, in many markets we went down 50%. So that's a crash in the United States. I think there's a good possibility that we're going to see that from the peak. So if you measure from the peak in the nationwide markets, I think it could go down far enough to where we'll call it a crash. We're already more than halfway there, especially in Canada. In Canada, you have two dominating housing markets around Toronto and around Vancouver. And so it's much more concentrated there. And the way these two markets go is the way the overall national indices go. And because of the weight of these two mega markets in the United States, we're much more diversified in the sense we've got a lot of very big markets all around. And so this is a more complex picture here emerging. But get from the peak, given where the peak was, which when you look at my charts, it's just ridiculous what happened during the pandemic with the free money that if that entire peak unwinds plus a little bit, I think we can call it a crash. And in many places, that means it'll be down over 25%, maybe more. And if it keeps going further, it will drag in people that bought before 2019. Right now, not many people bought during that spike in prices. That's the good thing. They went up so fast that there are not a lot of homeowners that bought at these prices. So there are not a lot of people that are really heavily underwater as this goes down. So the damage to the overall economy and to the financial system isn't going to be very big, but it doesn't involve a lot of homeowners. When you start dropping below the 2019 prices, then it starts involving a larger number of people, and then it becomes more of an issue with the financial system and investors and everybody involved in it, the economy overall.
What do you see happening with the used vehicle market?
So last year, I told everybody, go on a buyer strike, don't buy used vehicles now, and wait till they come down further. And that's kind of what happened. And people went on a buyer strike that revolted against these 40% price increases. And so sales volume fell, and inventory started building up a little bit, and prices started falling and came down pretty good. Just relatively speaking, in historical terms, they came down by a lot. But in terms of the spike they experienced, they only unwound a relatively small portion of that spike. And so now in December, the wholesale prices started rising again because there's pretty good retail demand. And then in January, wholesale prices jumped under quite a bit of retail demand. So dealers sell used vehicles and they have to replenish their inventory. They go to the auction to buy them there. And the supply to the auction comes from rental car companies and governments and other entities that sell large numbers of vehicles. And rental car companies have been short on vehicles due to the shortages. So the supply into the used vehicle market, it's there, but it's not very large, and it's smaller than it used to be. And so now we had this pickup in demand in January, and December was pretty decent. January suddenly, people buying these cars again. And so the dealers run to the auction, they're bidding up the wholesale prices. And then same in February, suddenly dealers are bidding up the wholesale prices because they're selling retail in the used vehicle departments, and they're having to replenish those units. So that will take a month or two to show up in our retail consumer price indices, but the prices, they're going back up, I think, and this is really crazy about inflation because you would expect that after a spike like this, prices will down a little further, but they're not, so maybe that's as far as they will go, and now they're turning around, and the used vehicle market is now, we're going into spring selling season with relatively tight inventories. So that's not a good sign. The rental fleets are starting to get a bigger supply from the manufacturers, but that will take a while before that wave of vehicles comes out of their fleet. So that supply isn't showing up for a while. So I think we're looking at fairly constrained inventories and pretty good demand from consumers, and dealers are having to replenish their inventories, so I think there will be further updrifts in wholesale prices, and until a large number of used vehicles vehicles are showing up at the auction or dealers can really load up, I don't think that we'll see really plentiful inventories and very aggressive pricing again for a while.
What's happening in the new vehicle market for your regular internal combustion engine vehicles and your EVs?
Well, so new vehicles since 2020, the new vehicle sales have plunged, and all of them combined, and as a unit number, and they plunged because fleet sales plunged because the manufacturers couldn't make enough vehicles, so they prioritized consumers. But even retail sales plunged because there just wasn't enough inventory. So now, and the first inventory shortages were on trucks and big SUVs. Now we get these high gas prices in early 2022, so the demand shifts from trucks and SUVs over to more fuel-efficient vehicles. And so now there's enough inventory for trucks, but people aren't really buying them anymore that much. And now they're looking for fuel-efficient vehicles, and the inventories are depleted in those. So we're still inventory constrained compared to what the market wants. And so new vehicle sales last year had plunged to the levels of 1970s in the United States. And it's just a huge drop. And that was supply constrained, not demand constrained. We don't really know what demand is, but we know, when there's enough supply, those units are starting to sell. Now, what has happened is that ICE vehicles have plunged further, and EV sales have exploded. And maybe that's the wrong word to use for EVs, but they have boomed. And so, by registrations, we know that in California, for example, EV sales jumped by a huge amount, and they're now 17%. There were 17% of the sales, and ICE vehicles sales plunged. And you wonder what other elements are in this, because Tesla never really had any supply problems with the semiconductors. It designs a lot of its own semiconductors. It has different supply chains than other automakers, and it didn't run out of vehicles like a lot of the other automakers did. And so Tesla is a big factor in California. So it manufactures cars in California. And so it had the number 1 and number 2 models in California. It beat Toyota Camry for the first time. And the Camry used to be the number 1 model for decades. And the Honda Civic was the number 2 model for decades. And now they've both been beaten by Tesla models. Some of that is supply constraint because Camrys and Civics are in short supply as fuel efficient vehicles are now being favored. and you can't find very many right now, so that's an issue. Now we've got a lot of other EV makers piling into the market, and they're starting to put out some pretty good numbers. And they're still years behind Tesla in terms of their supply chains. They have trouble building enough, but they're starting to put out some numbers. So we've seen that come up, and that's really what's selling right now in the entire industry. It's that the growth is in EVs, the decline is in ICE vehicles. And when you look at long term, and that's why automakers are spending billions and billions of dollars on EVs, on trying to design them, on trying to manufacture them, on getting their supply chains in order. Ford is laying off people in its ICE divisions, and it's hiring like crazy in its EV divisions. It can't even transfer very easily the engineers from its ICE vehicles to its EV division. So you have that going on, and the whole industry is having to adjust. And automakers are wondering how fast should they make this transition, because they're making money on their ICE vehicles, and they don't have the resources to plow full speed ahead with EVs and with ICE vehicles. They're having to, they're having to make compromises, and that's what they're doing. They're trimming back in the ICE vehicle plants, and they're boosting the EV vehicle plants, and everybody's looking at the sales numbers, and that makes sense because EVs are hot, they're selling, and ICE vehicles are not selling, and you have all the supply chain problems with ICE vehicles, and EVs are getting cheaper. The cheapest Tesla models now are well below the average transaction price for new vehicles in the United States, and it is now financially a good deal to buy an EV, and so that's the industry has now split in two. You have the growth part, that's EVs, and you have the decline part, that's the ICE vehicles. And that's from the demand point of view. That's just automakers see that. Everybody sees that the demand is what growth is, and they're trying to scramble to come up with enough vehicles to fill that demand. That's huge, long waiting lists for EVs. I mean, that's gigantic waiting list to get one. And so if I were an automaker, that's a very difficult decision to make. How do you reduce your one side of your business when you have limited resources, to supply the other side of the business where demand growth is, and the whole industry is reshuffling. So this is one for me I've worked in the car business for a while. And back in the day, and I used to work on cars. I love cars. I'm a car guy. And this is one of the most fascinating things to watch, how this plays out. How this whole industry is just getting shook up in a huge way by demand for EVs. There didn't used to be any demand for EVs. I mean, GM tried to sell EVs in the 90s and couldn't. There was just no demand for them. But now there is, and they've become mainstream, and the charging infrastructure is getting pretty good in places like California, and it's happening, and the automakers, the legacy automakers, are way behind, and they're just really struggling catching up. And meanwhile, the companies that are ahead on EVs, they're doing pretty well.
Do you think people are waiting on buying an EV until they feel the prices have come down a bit more? And will they ever make just a basic EV without all these super computerized additions to it that really jack up the price of a car?
Well, EVs, you can buy an EV for less than you can buy an equivalent ICE vehicle. So that's already the case. You can buy, in the United States, you can buy a GM Bolt for less than $30,000. I think they're $25,000, $27,000. And you cannot buy very many new ICE vehicles for that price. You get the cheaper little things, and a Tesla model, and those are nice. They're neo-luxury cars. They cost less than the average ICE vehicle. And, the F-150 pickup truck, that's an EV, is a four-wheel drive crew cab, so 4-door, 600 horsepower monster. And it costs far less than the equivalent ICE pickup. You have to go to a diesel, crew cab diesel, to get that kind of torque. And you have to go to a Raptor, it's a crew cab 4-wheel drive, to get anywhere near that horsepower. And they're all a lot more expensive and they're heavier. So if apples to apples, EVs are starting to be below where ICE vehicles are, and that's why some of the demand is picking up. In terms of the basics, the market in America really is. New vehicles have become a luxury market, and I've said this for years. They've long before EVs became a big thing. New vehicle manufacturers, automakers have gone upscale with everything, and they try to sell some low-end vehicles, and they just don't sell. They sit on the lot, and everybody wants to buy something nice. And so instead of spending $15,000 on a low-end new vehicle, they will spend $15,000 on a 3-year-old vehicle with all the bells and whistles. And that's how the American market is. And automakers have tried, and they kind of gave up. And so now they all went upscale, and everything is upscale everywhere. And it's close to $50,000 the average new vehicle price. It's ridiculous. It's $47,000 for the average new vehicle, average transaction price for a new vehicle in the United States. So the hope is that EVs will change that. There has been some price cutting. Ford and Tesla both have cut the prices. Some other manufacturers have cut the prices on their EVs. So we see new competition move in, and EVs are cheaper to manufacture than ICE vehicles. They're simpler. Tesla has the biggest profit margins in the industry, so it can cut in the entire auto industry. It has way bigger profit margins than any of the ICE vehicle makers. So it can cut its price by more than others can. And that's happening. So that's my hope, that competition will set in. We have a lot of new automakers come into the market with EVs, so hopefully we'll have some competition for the legacy automakers. And I see a new dynamism there I haven't seen in ever, since I looked at this industry, that may actually lead to some nice new vehicles at a lower price. And that's where I hope where competition in the EV market will go. I hope that there will not be a lot of buyouts, and that happened in the ICE industry. That one company buys another, and then you get this oligopoly again. So I hope that these players will be allowed to play, and that's what we need. We need lots of new competition, and ICE vehicle manufacturers need to fight back. They need to come up with competitive priced ICE vehicles, and they need to come up with competitively priced EVs. And hopefully we'll get new vehicle prices of any kind down to where, the average American can buy a new vehicle. Right now, that's not possible. The average American cannot buy a new vehicle, and they have, the prices have run away from them, and so it's become a luxury item. And I hope that the arrival of new competitors will change that.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Wolf Richter. And thank you for listening.